Welcome back to Global Money Talk live from the New York Stock Exchange. Only 4 more full trading sessions to go until November 1st, with only a handful of days until month end and a new month with highly anticipated events that will set the stage not only for the short term but also the long term. From the election on November 5th to the Federal Reserve rate decision on November 7th, the countdown is on. Joining me for today's market insight to provide perspective is Dan Ha, partner at Karani Asset Management. Dan, happy Friday. Great to have you back on the show.
Happy Friday. Thank you.
Well, 2 weeks since you were last on the show, and a lot has happened over those trading sessions, a slew of earnings as well as plenty of volatility across some key sectors. So what has stood out to you, and what would you like to share with our audience?
Sure. I guess over the last 2 weeks, the most provocative thing that I saw was Goldman Sachs's prediction of the S&P 500 returns over the next 10 years at 3% annualized. 3% annualized for 10 years comes out to be something like 34% total return over that period, over a 10-year period, which is a lousy return. And I mean, who knows? Maybe Goldman will be right, and maybe that's what we get. Maybe they'll be wrong. And to be fair, they did present a range in that report of between -1 and +7 over the next 10 years. That was their forecast, and 3% is about is the middle point of that. So who knows if they're going to be right? But I thought when I saw that report that the logic that they applied was really sort of worth following. And the reason why they made this prediction is really, there are multiple factors, but largely driven by 2 things. One, valuation, and second, the concentration level of the S&P 500, the cap-weighted S&P 500 to be specific. So first, the valuation. What's the issue with it? Well, before we talk about the valuation levels of the S&P 500 today, it's important to just remind folks that valuation, all else being equal, when you pay high price, that's going to eat into your returns. Meaning, if you pay a high price, it's going to reduce your rate of return, all else being equal. That's just math. The S&P 500 right now, the metric that Goldman Sachs was looking at for this particular report is what's known as the cyclically adjusted PE, or the CAPE. And the difference between the CAPE, the cyclically adjusted PE, and the regular PE is that the CAPE looks at today's price relative to the average earnings of the last 10 years. So it tries to smooth out the cyclicality in the earnings results of the companies, whereas the S&P 500 is, the regular PE is often looking at price divided by, say, last 12-month earnings or the next 12-month projected earnings. The CAPE measure for the S&P 500 is currently at 38 times. To put that into perspective, 38 times comes in at the 97th percentile of that reading, going back to 1930. So the current PE, cyclically adjusted PE, is basically at around record highs of the last 100 years. So we're starting at a very high point, which, again, all else being equal, will reduce, or ought to reduce, the rate of return going forward. Now, what makes investing difficult is that you can't just look at PE and predict that, all right, we're going to have good returns or poor returns. If that were the case, everyone would make money and avoid losses, right? There are plenty of periods over the last 100 years where market traded at a high PE, yet the forward 10-year returns of the index was robust, and vice versa. So you can't just look at PE, but that's one of the factors, or that's one of the reasons that they cite for their sort of return going forward. The second is concentration. So, I'm sure we've all heard about how concentrated the S&P 500 is. the point about that is, the important thing about that is, historically, when the S&P 500 is that concentrated, usually what followed were periods of pretty poor returns. Right now, the S&P 500, the 10 largest companies in the S&P 500 make up of something like 36% of the overall index. Those 10 companies, these numbers aren't super fresh. They're a couple of months old. We ran it at our firm. Those 10 companies, their earnings collectively is about 28, sort of high 20s percent of the aggregate earnings of the S&P 500. So their market cap is in the mid to high 30s of the aggregate S&P 500. Their earnings share is high 20s of the S&P 500. What that means is that clearly the market expects that those companies will, their share of earnings will continue to grow over time. Because if not, if the expectation is that the earnings wasn't going to grow faster than an average S&P 500 company, then the market share or the market cap share would be about the same as the earnings share. So the market is expecting these companies to continue to grow faster than a typical S&P 500 company. And in order for that to happen, what do you need? You basically need to have continued robust revenue growth out of these companies, as well as high margins from these companies. Historically speaking, maintaining high growth and high margins for the largest companies is just very difficult. So this time it could be different, like the current 10 or some, those could be the, the winners over the next 10 years, continue to be the winners. But if you're making purely that bet, then you kind of do have probabilities against you, stacked against you. So, those two things are the reasons why Goldman Sachs predicts that the S&P 500 returns over the next 10 years is going to be quite lousy.
And Dan, I think it's so important here to make the distinctions that you did in order to understand what's going on here, because if you see this headline from David Kostin, the Goldman Sachs chief U.S. equity strategist, with his 10-year market forecast, you might just think, oh, is this a reason to panic? And initially it might sound depressing because, as you mentioned, the year-to-date gains that we've seen in the S&P 500 this year are considerable, over 20%. And even when we're looking at the equal weight for the S&P 500 year-to-date, we're up about 15%. So while on the surface this might sound depressing in terms of the forecast from Goldman Sachs, what can one do to prepare under this assumption here?
Sure. So first of all, Goldman's recommendation, therefore, is to focus on the S&P equal weight as opposed to the cap-weighted, the normal S&P 500 that we all know of. And that is because, obviously, if your prediction is that the S&P 500, the regular S&P 500, is going to deliver lousy returns over the next 10 years, and S&P 500 top 10 make up about a third or more than a third of the S&P 500, the value of the S&P 500, then by definition, you're implying that those largest components will underperform the rest over the next 10 years. So if that's the prediction, then you want to focus on the rest, and the way to do that is by investing in the S&P equal weight. There are a couple of other ways that this could play out. So first of all, they could be wrong, but let's assume that they'll be right. Even if they're right, there are a number of different ways that this plays out. So like I said, the largest guys could underperform and the smaller 490 could outperform. That's one way this might happen. Another way that this might happen is that everybody just kind of, slowly and gradually appreciate more or less about 3% a year over the next 10 years. That is very unlikely to be the case. But if something like that happens, what you want to focus on is probably growth. What I mean by that is, if you're expecting sort of a lousy or sluggish equity return environment in general, what you probably want to have is growth, because companies that are growing are going to be the ones that actually power through that sluggishness and deliver outperforming results. And in order for you to, when I say growth, to be clear, I mean earnings growth. But in order for you to have sustainable earnings growth, it's kind of hard to do that without sustainable revenue growth. So basically, to put it really simply, you want to look for companies that are healthy and that are growing healthy. And by growth, I don't mean just like high flying, high growth, growing 20-30% a year type technology companies. A consumer staples company that's growing, say 8-9% a year in an industry that grows mid to single digit, that's plenty of growth. That's very healthy growth. So, certainly by no means am I saying if this is the scenario you predict, then, buy growth at all costs. Not saying that at all. You do have to pay attention to valuation, but you do want to, for the next 10 years, if you're looking for a company to own for the next 10 years, you do want to look for companies that are going to sort of sustainably grow over that period. Another way that this future, this 3% growth appreciation of S&P 5, total return of S&P 500 over the next 10 years, another way that this happens is that at some point that the market actually corrects meaningfully. 3% yield on the S&P 500 is not enough of a return. What is the proper equity discount rate is a debate that'll probably never end. No one can really tell precisely, but I think most will agree that 3% isn't it. Like 3% is way too low. So then what needs to happen for the equity market, for the S&P 500 to deliver better than 3% returns to the investors? Well, price has to go down significantly. And whatever you think the proper equity discount rate is, if the right number is somewhere between, say, 7 to 10%, just looking at, equity returns historically, under that scenario, S&P 500 from this point would have to fall somewhere between 30 to 50% price-wise to deliver 7 to 10% returns instead of 3% returns over the next 10 years. 30 to 50% decline it's not just a bear market, that's a crash. So that's a really scary scenario, but the problem with that is you don't know when in the next 10 years that'll happen. And Goldman actually predicts that returns for, I believe this year, is actually, they're not predicting that there's going to be a crash, immediately because of this view. Therefore, it's very hard to kind of prepare for the crash if that's what you're trying to prepare for. So I do come back to, and I say this almost every time I come on the show, and sorry if I'm being redundant, but it's just that important. You do have to maintain balance in the portfolio. Take extreme positions at your own risk, because when you do, and if the event doesn't happen, then that could be pretty bad for you. So it's hard to really play this exactly timing-wise, but it is something that you have to keep in mind and incorporate it into your risk framework, risk management and portfolio construction framework. Otherwise, you could get really burned by taking, extreme positions one way or another.
And I think you bring up an important point when you talk about potential scenarios, because we have absolutely no way of knowing what's coming down the pike, what's on the horizon. So to walk through these scenarios, I think it's very helpful for the viewing audience. And before we move away from this topic, you mentioned a key word there, and that is growth. And that is something that we hear about, whether we're talking about mega cap growth or large cap growth versus value. So can you explain the distinction there? And when we're also walking through these potential scenarios, what does that look like, the whole growth versus value story?
Sure. So growth and value they mean something in things they have a specific meaning in the investment sort of context. Usually when people talk of growth stocks, they mean companies that are growing at high rates and therefore often trade at high PEs. And value stocks, they mean companies that are trading at low PEs. But growth is a component of value. If you can buy a unit of growth at a low price, was that a growth investment or a value investment, right? So you always have to be, even as you think about, all right, I want to buy a growing company, you always want to be thinking about what am I paying for that growth? So they actually go hand in hand. But when you're picking funds, for example, or an index fund or an actively managed fund, usually they'll have, so-and-so growth fund, so-and-so value fund. But I think the more important thing to remember for our audience is that growth is a component of value. And when you think about growth, when you're trying to buy a growing company, you want to be thinking about, that doesn't mean you don't have to pay attention to valuation. You do have to be thinking about what am I paying for a unit of growth. And for a long-term investor, at some point on the show, I mentioned that for a long-term investor, quality is always important. And growth is also a component of quality. It's very hard to have a company, a high-quality company, and by high quality I mean company that sustainably generates strong earnings. It's very hard to have that if your business is in a decline. So if your business is going to get smaller and smaller every year over the next 10 years, I mean, you might be able to trade that as a stock cyclically, but it'll be probably very difficult for that company to be worth a lot more 10 years from now than it is today. I'm not saying it's impossible. You can do some smart financial engineering, buy in a lot of stock. You can do those things to increase shareholder value, per share shareholder value. But generally speaking, it's pretty difficult. So I do think that for a long-term investor who's got a long-term investment horizon, focusing on quality and thinking about growth as a component of that quality is extremely important.
Yeah, I think that's such an important distinction to make, because when we were seeing the volatility in the markets on August 5th this year, there was a narrative about how there's a rotation into small caps and the Russell 2000. So I think for the viewing audience, it's important to keep all of these factors in mind.
Right, right.
And Dan, we are getting close to the election here in the U.S., November 5th, so less than 2 weeks away. I know that you said on the show previously that you wouldn't place a bet one way or another, but as we continue to monitor the polls here in the U.S., is that still your stance?
Yes, absolutely. The betting markets, Bitcoin, the polls, news headlines, they're all expressing a view one way or another, right? More power to you if you want to place a bet based on that. To me, the outcome of the election, even though every day, we hear, the polls have skewed this way or that way, the betting markets are saying this or that. To me, it's still way too binary for it to be an attractive investment proposition. Now, one might argue that I think it's the general view that a lot of these sort of betting market types or asset markets are pricing in increasingly a Trump victory, and Bitcoin or whatever that may be. Therefore, one could argue that actually, if you want to bet on a Harris victory, it's actually an asymmetrical situation, because these markets are pricing in a Trump victory. But if you think the outcome is actually 50-50, then if you place a bet on a Harris victory, and if Harris wins, then you'll get a bigger upside. Technically true, but I don't think the asymmetry is that meaningful enough for me to find it an attractive investment proposition. So, I still stand by my view that, I wouldn't bet on a coin toss, and therefore I wouldn't bet on the outcome of the election. David Einhorn of Greenlight Capital the other day went on TV and said that the only prediction that he'll make about the election is that it'll be on November 5th. And I will make the same prediction and make no further prediction. But I do want to say that recently when I was on the show, I talked about the risk of inflation sort of reaccelerating. Whichever candidate wins, it seems pretty clear that that neither candidate is interested in sort of cutting back spending. Both have big plans to increase spending. They both have explanation of how they're going to be able to afford that, but I don't think the reality is going to be that they'll actually be able to fully fund that. And so whoever wins, it seems like they're both highly incentivized to increase the spending by the government, therefore the debt load of the country. And whoever wins, that to me seems rather inflationary. I doubt that whoever wins, I doubt that they'll be able to do everything that they're now talking about doing. I don't think they'll be able to achieve all of that spending, but it's not really, it's a matter of how much will they be able to spend. I don't think either candidate is really that interested in, cutting back, reducing the debt, balancing the budget. Therefore, all this sort of plans of spending naturally is inflationary, and therefore I think that sort of incrementally increases the risk of a inflation reacceleration, no matter who ends up in the White House after the election.
And before we move away from this, just because when we look at the calendar for the month of November, as you mentioned, we have the election on November 5th, and that is most certainly a certainty there.
Right.
But following the election, we do have the Federal Reserve meeting. They start their two-day meeting right after Election Day, so November 6th to November 7th, with a rate decision expected that day. And of course, the Federal Reserve does keep an eye on inflation. So when you're talking about either candidate in the White House, and if we're looking at an inflationary environment, what would that actually look like for the economy?
Sure. So like I said, the risk of inflation reaccelerating is, I believe, incrementally higher. Does that mean that I'm therefore incrementally bearish? Not necessarily. And this is also why investing is really difficult. It really depends on how much it reaccelerates. So it's not so much the direction that matters, it's really the magnitude almost. In the past couple of weeks, we actually heard from two legends in the investing world, Stan Druckenmiller, I believe on Bloomberg, and Paul Tudor Jones on CNBC. Stan Druckenmiller sort of articulated how inflation reaccelerates. And to be fair, he wasn't making a prediction, but he was sort of describing, if it were to, how it happens. And if you think about it, right now, it's hard to say that financial conditions are really tight. Asset prices of various kinds are all at records, whether it's stocks, gold, Bitcoin, home prices. They're all at or near records. And the Fed is cutting rates into these very sort of strong asset prices. So another way to say that is, asset prices are high, labor market economy still appears to be strong, and borrowing is about to, or has gotten and is about to get cheaper. Those combinations are more likely to be inflationary than deflationary. Therefore, if that happened, that is how a surge in inflation reacceleration happens. And if it happens that way, if inflation goes back up by a lot, I don't see how that would be good for equity markets. Now, Paul Tudor Jones, on the other hand, had an interesting comment, and he too believed that lots of things in the economy, the government policy, and everything also pointing to inflation. But he was also talking about how the U.S. government could get out of that situation, which is a serious problem that at some point will have to be addressed. And in order to, he had recommendations about increasing tax rates and letting tax cuts expire and reducing spending here and there. But the most effective way to solve the debt problem of the country is by basically growing out of the current debt situation. And basically, if I could use an analogy, like that student loan that somebody takes out in their late teens or early 20s, that was probably a lot of money to that person at the time. Fast forward 10, 20 years, when that person is now earning a lot more money than just whatever money that they were making on their side job as a college student, they're making far more money now, and therefore the amount of the loan is less meaningful, less burdensome to that person. So now, in order for you to therefore grow your way out of that debt problem, you have to have an economy that is growing. And what do you need? What does that mean? You need nominal growth. In order to have nominal growth, you need to have some inflation and some real growth. And in order to have real growth, you do need spending, and you do need support of the monetary. You do need monetary policy support for that to happen. Therefore, in sort of the world that he described, and again, he wasn't making a prediction either. He was suggesting that this is how we can get out of the debt problems. In that kind of a world, it seems like inflation, a little bit of inflation is a good thing, because the economy, the Fed would be dovish, inflation would be kind of moderate levels, maybe slightly higher than where it is now, but the economy would also be growing nicely, and all problems would be solved. Therefore, inflation resurging, as I said at the beginning of this question, is not necessarily just a directional question. It's really a question of degree, and what I'm saying is basically it's too hard to know. It's impossible to know almost what the degree or what the magnitude of that increase is going to be. Therefore, it's very difficult to play it as an investor. But like I said earlier, you do have to keep that in mind as you think about your portfolio construction and risk management, so that you're not taking on unintended risks by holding on to certain positions that may be exposed too much to one scenario or another.
Mm-hmm. And Dan, I'm glad you highlighted some of the discourse surrounding the potential for resurgence of inflation. And speaking of assets hitting all-time highs, one name that we have seen hit recent record highs is Nvidia. So before we wrap it up for today, give us your summary of Nvidia.
Sure. So just looking at the past couple of weeks, what I observed was quite interesting. So if you think about the semiconductor space, the first thing that happened over the last couple of weeks was ASML. ASML reported earnings. Its forecast was disappointing. The stock got hammered and sort of brought down all the other names in semiconductor and sort of the greater supply chain, if you will, of the semiconductor industry. And then TSMC reports earnings, and it was quite good, and that changed the sentiment of the semiconductor sector as a result. Meanwhile, in the midst of all of that, and in the midst of this, negative and positive, Nvidia basically just went on and just, continued on and made new highs, as if none of it really mattered. I think what's going to happen, and it has been happening, is that Nvidia increasingly is becoming more and more about the installed base and the software story, which I've talked about on the show before, and less about purely sort of hardware cycle. Hardware cycle will always be an element of the Nvidia business so long as it is selling hardware. But similar to what happened with Apple's iPhone in the early days, which is a comparison that I made on a different episode, in the early days of the iPhone, there were lots of people talking about, this particular phone by LG, it's got better specs, it's got faster chip, it's got better camera, it's a better phone and it's cheaper. Or that particular phone made by some Chinese manufacturer is just as competitive. But at the end of the day, iPhone won out, not because it had the best hardware specs, but because it ended up developing an ecosystem, i.e. software, around it. And iPhone became, now specs mattered, but iPhone essentially became the hardware to access that ecosystem. So I think that is becoming increasingly the understanding for Nvidia, and I think the company is very intentional about making sure to sort of strengthen that moat of the business, if you will. So I think the future, again, is very exciting. The only thing I'll say, though, is, again, high exciting potential means high expectations. So you do have to position it appropriately in the portfolio. I would say, I own it, but I'd say you have to own responsibly to Nvidia. So I'll just leave it at that.
Okay, Dan, well, we've covered a lot of ground today, so thank you so much, as always, for providing all of your insights.
Very welcome.
Thank you. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on SamPro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We'll be back bright and early on Monday morning. Have a great weekend.